I'll start by giving a very brief introduction to the asset class. And then secondly, I'll start to talk about some of the misconceptions and misunderstanding of emerging market debt. A good example of this is a former head of fixed income of mine at a previous job. He once told me, I would never invest in a country where I couldn't take my family on vacation. And one of the things I find when I talk to people about emerging markets is that it conjures up these images of faraway places, low levels of development, etc. And we think that as investors, we should be focusing more on the longer-term risk and return characteristics of the asset class. Specifically, we like to look at it through the lens of implied probability of default and loss given default and see what's actually baked into credit spreads, as credit spreads should be forward-looking expectations of the probability of default times the loss given default. Lastly, I'll wrap up quickly with a very brief overview of where the opportunities and outlook is for the market and the current market conditions. So very briefly, I'll just give an introduction as to what emerging market debt is for those who are not familiar with it. Emerging market debt is fixed income securities issued by governments, state-owned entities, otherwise known as quasi-sovereigns, as well as corporations. It can be issued in hard currency. So for example, if Brazil wants to issue a bond denominated in US dollars, then we as investors, the primary risk we would face would be credit risk, as Brazil would have to go out and earn enough foreign exchange to pay us back in dollars. Alternatively, issuers can also issue in local currency. So if Brazil wants to issue a bond denominated in Brazilian real, then the principal risk we would face as investors would be inflation as well as fluctuations in the exchange rates. If Brazil got itself into fiscal trouble, it could print more money. This would put pressure on the exchange rate and also put pressure on yields, causing them to rise and ultimately hurt our investments. Emerging markets today account for about 46% of global GDP, with the IMF forecasting that it will go up to 60% by 2030. The current share of global fixed income amongst emerging markets is roughly about 20%. So we think there's sufficient scope for this asset class to grow and mature in line with its share of global GDP. One of the misconceptions about emerging market debt is many people think I'm getting an adequate allocation to the asset class simply by owning a global bond portfolio. One of the things we tend to find is that most global bond indices actually underrepresent emerging market debt in their indices. Most global bond indices have about a 5% allocation to EMD. Additionally, most active managers tend to be underweight. This could be for many reasons, but it might be just not having adequate skills in-house to properly assess the risks involved with emerging markets. The purpose of this slide is just to show the breadth of emerging market debt. I saw the previous panel, someone asked a question about how would you segment or divide emerging markets into smaller categories. One of the things we do in our investment process is we tend to segment the universe into high, medium, and low beta countries, as emerging markets is in some ways almost like a catch-all for everything outside of developed markets. You have very different levels of credit quality. So for example, you could take the People's Republic of China, which is, a $15 trillion economy plus $3.2 trillion of international reserves, and this is in the same emerging market debt index as Nigeria. Although it's it is the largest economy in sub-Saharan Africa, GDP per capita is only $2,000. So what we tend to do is we tend to look at the historical betas of the countries that we invest in and group them together into subsegments to help us manage our risk a bit better. Both of these are examples of bonds, sovereign bond issuers, if the government issues a bond. An example of quasi-sovereign debt would be something like Pemex or Pertamina, which are both state-owned oil companies. Pemex is in Mexico, Pertamina is in Indonesia. And quasi-sovereigns have a different purpose than your typical corporation. Their mandate is twofold. One, to try and generate profits for their owners, which is the state. And two, to help implement policy. So a good example of this is Pemex is undertaking an $18 billion refining project, oil refining project in Tabasco. This is very uneconomical. The project itself will likely be NPV negative, but they're doing it at the behest of President AMLO for two reasons. One is nationalistic and also somewhat security related. By increasing the ability to refine crude product domestically, they are reducing the reliance on foreign markets. And secondly, it's to help develop an underdeveloped part of Mexico, where jobs are scarce in Tabasco. Lastly, there's corporate debt. And there are many different types of issuers in corporate debt. A good example might be Banco Ito in Brazil, which is a financial firm. Miners such as Anglo Gold Ashanti in South Africa, as well as the internet company Tencent in China. Oh, cool. I didn't realize there's animations here. These are examples of the emerging market debt indices. And we'll start by going from left to right, from least complex to more complex, which is local currency sovereigns. So the first index is the MB Global Diversified. It is the oldest index. It's a hard currency index, so i.e. Brazil wants to issue a bond denominated in US dollars. It's about 50% IG, 50% high yield. It comes out if you use S&P ratings to be BBB minus. The yield of the index is about 8.57%. And one of the things that people find surprising when I talk to them about the emerging market debt and the MB Global Diversified is it's got a long-term annual default rate of 1%, which tends to be not in line with most people's perceptions. But I'll talk a little bit later in the presentation as to why default rates in emerging market sovereigns historically have been so low. The second index I'd like to talk about is the NextGem. This is the frontier market index. And I'm presenting this as a proxy for the high yield part of the universe, which for those investors who are interested in higher returns, it's a very important part of the index to accomplish that. Every single bond that is in the NextGem is also in the MB Global Diversified. It's a subset. The NextGem is a single B rated index. The yield is about 13.6%, which is obviously quite high, and it's only got a slightly higher long-term default rate of 1.5%. Next, emerging market debt hard currency corporates. These are slightly more complex to manage than sovereign portfolios, because not only do you have to manage country risk, but you also have to manage sector and issuer risk. Like the MB Global Diversified, this has got an average rating of BBB minus. It's a shorter duration at only 4.46, and it's got a yield of 7.09%. Long-term annual default rate is also in line with the NextGem at 1.55%. And then lastly, the local currency sovereign index, the GBI-EM. This is AA minus rated. There have been no defaults in the index over the last 20 years. As we talked about in the Brazil example, many of these countries, if they find themselves in fiscal stress, they end up printing money to solve the problem. And then we as investors bear the brunt of it via inflation dynamics. This is the larger market cap index at 1.2 trillion or so, as most countries, as you can imagine, prefer to fund themselves in domestic currency. For the purpose of this presentation, we're going to focus more on hard currency emerging market debt. We do think local currency can be an attractive source of returns, but we think of it more honestly as a tactical asset class. And if you're more interested in that, I can talk about it after the presentation. So here are some of the structural characteristics of emerging market debt. As we talked about previously, it's under-owned. It's an inefficient asset class. It's one of the few asset classes I can think of where the median manager, if you're average, you're beating the benchmark. It tends to be undervalued, and this goes back to this point about implied probability of default and loss given default. As many investors overestimate the risk, it tends to have higher risk premia and be more volatile than developed market counterparts. And lastly, it's got a yield advantage. This chart on the right shows the risk and return characteristics over the last 15 years of various fixed income indices as well as emerging market debt indices. And although they're not shown here, one of the more interesting things about emerging market debt is over the last 15 years or so, depending on whether you're looking at global equities or EM equities, they've shown similar or in some cases better returns with a fraction of the volatility. So now that we kind of looked at some of the backwards looking characteristics on how emerging market debt has performed over the last 15 years, we thought it made sense to look at this in a more forward-looking context. So we put this slide together as part of a very basic, asset allocation, efficient frontier exercise we did. And what we did on the bottom three over here, we just picked what we think are typical investments in domestic U.S. fixed income. U.S. corporate credit, U.S. core fixed income, represented by the Barclays U.S. Ag, as well as the subcomponent, the U.S. Treasury Index of the Barclays Ag. And then what we did is we took a look at the asset classes with credit risk. So in this example, U.S. high yield. When we did this exercise in late June, early July, it had a yield of 7.1%. And to get an idea of expected returns, we subtracted out the credit losses. And how we got to the credit losses was we took the long-term averages. So over the last 20 years or so, U.S. high yield has had a 3.5% default rate and has recovered 35 cents on the dollar. So 3.5% of the time, you've lost 65 cents on your investment. And so once we subtract that out, we get a forward-looking adjusted yield of 4.9%. We also did the same analysis with the various sub-asset classes of emerging market debt. Take, for example, emerging market debt high-yield sovereigns, which, when we put this together, had a yield of 10.65%. Long-term default rate has been 2%, with a 55 cents on the dollar recovery rate. So, to my knowledge, this is one of the highest recovery rates among fixed income asset classes that I'm aware of. We also did a similar analysis with EMD corporates, and we got an adjusted yield of 5.48. And then what we tried to do was try and create what we think is a very typical or reasonable emerging market debt hard currency allocation, which is 20% emerging market corporates in the SENB, 30% emerging market sovereign IG, and 50% high yield. And we got the adjusted yield of this blended emerging market allocation at 7.38%. The next thing we did is we took these forward-looking expected return projections, and we tried to put them in your very typical efficient frontier. So on the x-axis, we have volatility measured by standard deviation, and on the y-axis, we've got these now forward-looking projections of expected return. And then when we crank the numbers, we got this blue line over here. This is what the efficient frontier looks like if we only included domestic assets. And then so once we put emerging market debt in the opportunity set, we see the line shifts up into the left, which is where we want it to be, as the previous presentation was just saying. If you can earn a higher return for the same level of risk, that's net beneficial. But ultimately, just take this as very illustrative. The purpose here is just to show that by expanding beyond your domestic opportunity set, there's opportunities to increase diversification and enhance returns. And additionally, what's important when you're thinking about risk, risk is never just a number. Thinking about it logically, by increasing your exposure and your diversification to different countries and different regions, you're reducing your concentration risk, which could benefit you over the long term. So now that we've talked about the outlook using a more quantitative approach for emerging market debt and valuations, let's take a look more simplistically at what's happened over the last 5 years. So in this top left-hand chart up here, this is a graph of emerging market debt IG sovereign spreads over the last 5 years. So as you can see, when the COVID pandemic started, IG spreads, along with many other risky assets, they blew out, and they quickly reverted back within their long-term mean, a very short spike up when Russia invaded Ukraine, but now back within its long-run 10-year average. So our assessment of EM-IG spreads is their average. We still think it's an important part of a portfolio for diversification and risk management benefits, but it's not screaming as a particularly attractive opportunity. Next, if we do that same analysis with emerging market high yield spreads, during the pandemic, they blew out to very high levels, about 1,200 basis points or so. They quickly recovered back in line with their long-term mean, but over the last 6 to 12 months, they've been slowly drifting higher. So why do I think that's the case? What do I think's been happening here? I think this has been largely driven by expectations of tighter monetary policy, the Fed hiking rates, as well as a strong US dollar. And we'll talk a little bit later in the presentation how this has happened, how this has affected EM spreads historically, as well as it means as an outlook from here due to the impact of higher rates and a strong dollar. In the bottom right-hand corner, this is a comparison that's often made. It's the differential between emerging market high yield spreads, sovereign spreads, versus US high yield spreads. And we can see back into the pandemic, the spread differential was more in line with its long-term average. And then emerging market high yield spreads underperformed US high yield spreads. And this has been drifted slowly wider since the pandemic. So why do I think this is the case? I think the best way to explain this from my perspective is just a short anecdote from a friend of mine. I have a good friend who I went to school with. He was very excited in March 2020, April 2020. He left his job because the US Treasury Department had called him to come and help design what the corporate bailout regime was. And at this point, I think it was broad consensus, the pandemic was nobody's fault and extraordinary government support was required. And so 2 years later, I called my friend Stephen and I asked him, when you guys were designing policy, what was the primary goal? What were you guys trying to achieve during that period of time? And he told me, back then, honestly, they really thought the pandemic was going to be, 3 weeks to 3 months, and then everyone would kind of go hide in their houses, everything with the virus would work its way through or just disappear, and we'd go back to normal. And during this short period of time, their goal was to try and put the economy in stasis, to just prevent all bankruptcies, to try and prevent the collapse of the global economy and the US financial systems. And so I think that kind of explains a little bit of this differential over here is US high yield default rates on a trailing 12-month basis are quite depressed. They're about 1.3%. And I think this is largely due to the extraordinary stimulus and support that we got from the US government. So on a forward-looking basis from here, our own view is that US high yields defaults will accelerate at a faster rate than emerging market high yields defaults. Next, let me walk you through what is our own bottom-up analysis as to what emerging market defaults look like from here. So what we've done on the left-hand side is we took every country where we think there's even a modicum or a very small probability of default, and every quarter we update what we think on a 12-month forward-looking basis the probability of default is and what the recovery rate is over here. And then over here we have what the average price of the bonds. So this analysis was done in early August. There's 2 points I want to make here. The first one is just to focus on this column over here. And when we sum it up, this is the benchmark weight of all these countries where we think there's just even a slight chance of default. And when we sum them all up, we get about 10% of the index. Taking a little bit of a closer look, we find about 4% is Turkey, which we assign a very low probability of default of around 10%. And basically the story with Turkey is even though there are significant macroeconomic mismanagement, inflation is running rampant, there's unorthodox monetary policy and a lot of concerns with respect to external liquidity, we actually think it's a very low probability of default because Turkey has plenty of room to lever up. Debt to GDP is only 35% or so. So subtracting out Turkey and looking at what is the percent of the benchmark that we think has some risk, and we get to 6%. And from our perspective, this is not indicative of a brewing emerging market debt crisis. The next point I wanted to focus on over here is the expected loss. So what we did is we took the probability of default, our own internal assessment, we looked at where bonds are trading today, and we looked at where our assessment of recovery was, and then we try and figure out what is the impact to the index from these distressed sovereigns. And when we sum it up, we actually get a positive number of 0.85%. Why is this the case? Because we think so many bonds, there's so much risk aversion and fear priced into the market as a result of tighter monetary policy that we're actually trading below recovery. A good example of this is one of my boss back in July when markets were a bit shakier. He was sitting down at this global macro dinner amongst mostly macro investors. And every single investor at the table had to pick a top trade idea. There was 35 people in the room. We were the only ones who pitched a long trade idea. There was so much risk aversion. And that trade idea was to buy a basket of long duration, 30-year emerging market debt bonds with coupon rates, in high single digits at around 50 cents on the dollar, which is where they were trading. And so this just emphasizes the point that there was, maybe to the previous presenter's point about challenges with the liquidity environment, but the implied losses and risk premium in emerging market debt we think is dramatically overstated. This was a really interesting analysis we did. And what this is we looked at the last 3 Fed hiking cycles. And the point that probably the primary driver of the sell-off in emerging markets, as we discussed, is likely tighter policy. Strong dollar, that's bad for emerging markets. Higher US interest rates, that's bad for emerging markets. So we said, what's happened in the last 3 cycles? So what we found was in the first 12 months prior to the first Fed rate hike, emerging markets have underperformed or had very tepid returns. However, in the last 3 cycles following the first rate hike, emerging markets have delivered double-digit returns. So why is this the case? As we've seen time and time again, investors aren't wrong to think that higher rates and strong dollar is bad for emerging markets, but expectations of default, credit spreads just get too wide. So then when the first rate hike actually occurs, valuations are kind of depressed, and emerging markets is a relatively high carry asset class. Defaults don't pan out as the way people thought they would. So you start with a high yield, and then this leads to spread compression despite rising interest rates. And this has led to double-digit returns over the last 3 cycles. We did a partnership with some students at MIT, and I asked them to run varied mean variance optimization and asset allocation returns with various interest rate regimes. And I was shocked before I saw this. I asked them to rerun the numbers again because the highest earning regime they had was during periods of when the Fed had actually started to hike. So this was a little bit counterintuitive, but I think it's an important part of the message from where we go from here. This slide over here is just another assessment about what are fundamentals in emerging markets versus what's priced into the asset class. So this is one of our internal quantitative models, and what we do is on the x-axis we quantitatively assess the macro, the fundamentals of emerging market debt sovereigns. It's a combination of some ESG, predominantly government factors, as well as metrics like debt to GDP, et cetera. And on the y-axis, we have the credit spreads. Each one of these blue dots is a different country where we think it should trade based on its score and what the actual credit spread is. And this green line over here, this is the line of best fit. So one of the things that's different about our models versus many of our peers is that we tend to look at 5 years of history. So we can tell whether the overall opportunity set is net rich or net cheap. And there's so many lines above, or so many dots above this line of best fit where we think fair value should be, that this gives us more evidence that the opportunity set is intrinsically cheap relative to fundamentals. This slide is over here is another snapshot of the EMD fundamental outlook. And we're looking at some of the most important variables for assessing credit quality, GDP growth, fiscal deficits, basic balance, and debt to GDP. Unsurprisingly, in 2020, growth faltered. It collapsed in emerging markets. In 2021, it snapped back sharply, and it's been kind of slowly, gradually returning to normal levels. One important point to make here is the differential between emerging market growth and developed market growth over longer periods of time. It can be an important element in future capital flows and asset allocation. So as the differential between emerging markets GDP growth grows faster at a higher rate accelerating rate than developed markets, this can engender capital flows and could lead to better asset prices in the future. Currently, the IMF forecasts that this differential is narrowing this year, and that the difference between GDP growth in emerging markets and developed markets will continue to expand over time. Next, looking at fiscal deficits over here. During the pandemic, debt to GDP spiked by 10 points as revenues fell and spending increased in response to the pandemic. But much to my surprise, actually, the pace of fiscal consolidation occurred at a much faster pace than what we thought they have. And we see deficits contracting to between 2% and 3% by next year. Part of the story here is our assessment of what's going on in the Middle East. Emerging markets are net oil exporters. Historically, they've had a net positive beta to oil prices, and higher oil prices has caused our forecast of the Middle East fiscal deficits to switch to surplus over the next years, because at this price, they're just making money hand over fist. Basic balances, so this is your current account plus net FDI. This is arguably the strongest part of the story. And again, Middle East, we see a tremendous improvement in the external accounts. But as hard currency investors, this is one of the biggest problems we face is, can emerging markets earn enough foreign exchange to pay us back in dollars? And with such strong current account inflows forecasted via this basic balance number, and the potential for strong capital account inflows due to this difference between emerging market growth and developed market growth, we feel pretty sanguine about the outlook at the overall asset class level in terms of the ability to weather an external shock or their external liquidity position. Although there will be a few idiosyncratic cases, a few problem children here and there. And then just really quick on debt to GDP, due to the strong growth and strong fiscal dynamics, we see it declining over time, very gradually over the next few years. The only area where we see an increase in debt to GDP next year is in sub-Saharan Africa. But one thing I saw on my internal Bloomberg chat from my team's chat right before we came out here is debt in sub-Saharan Africa now versus 20 years or so ago has grown by about $100 billion. They've issued $100 billion worth of Eurobonds. However, almost the entire universe, with the exception of two notable countries, Nigeria and Egypt, are in IMF programs. So this is one of the most important but misunderstood aspects of emerging market debt, and an important driver as why default rates are quite low and recovery rates are quite high. And this has to do with the additional support from multilaterals and bilaterals. This is a very unique feature of emerging market sovereigns, is they have a lender of last resort whenever they get into trouble. And not only can this lender of last resort provide funding when no one else will, they also can act as a coach to make you a better, stronger, more robust economy in the future. Part of the IMF mission is not, monetary, it's poverty eradication, and helping developing economies fits into that goal. The other important thing to mention about defaults in emerging markets is there's no such thing as a sovereign bankruptcy court. If Colombia, Indonesia, et cetera, can no longer pay their debt, it's not like this. It's not like you liquidate Colombia and you try and go find what you can. So the way this usually works out is the real stick that we as investors have to try and encourage emerging market sovereigns to pay us is you say, well, if you default today and you don't, we come to a resolution, you won't be able to access international capital markets in the future. And if you think about human nature, these governments are run by people, politicians, and they want to have the ability to run fiscal deficits and financing so they can fund infrastructure, social programs, etc. This, plus a degree of nationalism, has historically led to very high recovery rates because the threat of, without perpetuity, not being able to access international capital markets has caused high recovery rates amongst emerging market debt sovereigns. So when we think about the outlook or the attractiveness of emerging market debt as a whole, we slice it in three key lenses. The first one is fundamentals, where we think fundamentals are still net negative despite very strong fundamentals amongst emerging markets amongst themselves. But the risk is really coming from top down, from the Russia-Ukraine crisis, higher monetary policy, inflation, and although we think a lot of this risk is already priced, we think it's still net negative, but we see this on a negative but improving trajectory. As we mentioned earlier, some of the net positives is standalone fundamentals, or the fundamentals of the asset class look good, higher commodity prices, and IMF and bilateral support. Technical conditions we think are net negative. Year to date, we've seen $55 billion of outflows from emerging market debt. But this started to reverse in late July, or early July, or mid-July, when valuations just became too stressed. And we saw about $500 million to $1.5 billion into the asset class pretty consistently over the last 6 to 8 weeks. On a forward-looking basis, there's some potential headwinds in September, as we see many IG sovereigns coming to market to issue new debt, specifically in the 5 to 10 year part of the curve. And lastly, more importantly, valuations in emerging market debt are quite attractive. When we think about the all-in level of yield of the asset class, there's really only 2 times in recent history where we've seen yields this high. The first being the global financial crisis. When you think about what was going on there were serious questions as to whether the financial system was going to collapse. Nobody knew what was going to happen. It was existential. Second, in the onset of the COVID pandemic, when we thought this virus is going to sweep throughout the whole world, cause economies to collapse, we had no idea what was going to happen, and we thought mortality rates were going to increase. And then there's today. And so net, this has not been, a fantastic year. Fundamentals have declined, most risky assets have underperformed. But when we think about where valuations are today versus the last 2 times in history where at this level of yield, we think the asset class is mispriced. So second to last slide, let me walk through what we think the outlook is for emerging market debt is. And so this is scenario analysis of how the index could perform based on where credit spreads go and where US 10-year rates go. So we did this analysis, I think, when the MB Global Diversified was trading at spreads of 490 basis points, and US 10-year was about 2.875. So as we've discussed earlier, we think that as markets tend to normalize, realizations that the emerging markets are oversold, this will lead to contraction of credit spreads. So our base case right now is within a year, credit spreads go to 400. Our base case is, even though we think the Fed continues to hike, we think the curve continues to flatten. So we see a lot more pressure on the front end of the curve than the intermediate to long end of the curve. So our base case next year is, about a year from now, 3%, which is where it is now, 10-year Treasury. And if these two things happen, we would see a total return of 16.6% of the asset class. So this is reminiscent of the previous 3 Fed hiking cycles. And it reminds me of the Mark Twain quote. History doesn't repeat itself, but it has a tendency to rhyme. Given that these variables are very, very difficult to forecast, we're providing a range of what the possible outcomes can be. And even we get to what we think is the most negative scenario, if credit spreads widen about 50 basis points and US 10 years goes to 375, we still see a net positive return of the asset class from here as we're cushioned by the extraordinary high carry and high yield of emerging markets. So lastly, just to wrap up, we start with a very brief introduction of the asset class. If people are interested in talking more about it, we can talk offline. Then we start to hopefully dispel some of the myths and misconceptions of emerging market debt. Hopefully we've differentiated between the decision on where you want to bring your family on vacation versus how you should be thinking about investments. And then lastly, we gave an outlook on where we think we're going from here. And the conclusion is we just think valuations are just too stretched. Over the last 3 to 4 weeks, it's just been a litany of articles saying the same thing. So I think this is becoming in line with market consensus. So even though most asset classes have underperformed year to date, we think emerging market debt is quite attractive right now, especially for those that need income and who want to limit some of the potential downside from here, given how depressed valuations are.